Your reaction to those comments from Jamie Dimon?
Hey, look, I don't think it could be much better if you're running a big global bank right now. There's frankly not that much competition among big American Wall Street type banks. The economy is obviously doing well. Interest rates are still at historically low levels. They still get their basic raw material, which is our deposits and cash, basically for free, and they make money on the spread. And I think they know how to make money. They've been making money. Jamie Dimon's been making money, at a clip of about $8.7 billion in net income per quarter now. I mean, how do you get better than that? So there's a little sell-off, yes, but maybe that's healthy. And he's had a huge run-up in his stock and in his business, and I expect that to continue. So can't get much better than this.
Tom, clearly the share prices aren't pointing to that sort of sentiment. Do you think there's something that these CEOs are missing?
First of all, I would say that as a fund manager of a financial services fund, I don't find the sell-off healthy at all. In fact, the heart is a little troubled by that. But I've talked to 20 CEOs in the last 3 weeks, and to a man and a woman, they all say the same thing that Jamie Dimon said about the economy, though some of them don't have international businesses. But it's clear that their customers are telling them that the only problem they see is hiring qualified labor. But from a orders and revenue standpoint, the banks are fine and the customers are fine.
So are you seeing this, Tom, overall as a buying opportunity? And if so, which names are you putting into, and which sort of subsectors and types of banks?
Well, right now, you've got the banks trading at about 8 times earnings. 8 times earnings when the market is trading at 15 times next year's earnings. So I think for a well-managed, growth-oriented bank, whether you're talking JP Morgan, whether you're talking Bank of America, even regional banks like Meta Financial, Tri-State Capital, these are all companies that are looking at very good 2017s and trading at single-digit multiples.
Bill, just to that point, I want to get your thoughts on this. I mean, why do you think there is such a disconnect between what CEOs of these banks are saying and sort of and how they're sort of presenting their business and what we're seeing in terms of share price? I mean, if you've been buying into financials this year, you're down 10% with the sector year to date.
Look, and if you own Goldman Sachs, you're down, 28%. I mean, Goldman Sachs went public at 4 times book. It's now trading below tangible book value. I mean, I don't know. Thank you, David Solomon. I mean, what kind of welcome is that for David Solomon? He's got, there's obviously a bit of a minor scandal or a scandal of sorts involving, the Malaysian sovereign wealth fund. That's not good, but I think the market is clearly overreacted. Why is there a disconnect? I don't think people understand what's going on. When the yield curves invert, they don't like that. I think this whole self-inflicted wound with trade in China is not helping anybody because CFOs don't know what to do. They don't know how to plan. They don't know how to think about things. And I think that's very detrimental. But again, you've got, if Donald Trump is to be believed, and we have 3.5% GDP growth, interest rates at historically low levels still, and yes, maybe going up a little bit from time to time, but the economy is doing well, unemployment is low. I think this is a buying opportunity, and to Tom's point, yes, of course, every sell-off hurts, but the stock market has gone from 17,500 to 24,600. Its peak was in January at 26,600. We're down maybe 8% from there. I think if we just step back for a minute and take a deep breath, we can all be pretty thankful about if you're an investor in the stock market.